What's up, everyone? It's Sean from Predicting Alpha, and today I'm going to be taking a look at Spirit Airlines. So, Spirit Airlines is a stock that has been getting a lot of attention in recent times, along with all of the other airlines, because they've taken a serious hit because of this whole coronavirus situation. Nobody's flying these days, so it's caused a major spike in volatility for these companies and a major drop in terms of their share price overall. So, today I'm going to be taking a look at SAVE from the perspective of the options market, breaking down for you what's going on in the option space and what can that inform us about what's happening with the company. So what we're looking at here is a bunch of information about the options being traded around Spirit Airlines. Now, the amazing thing about options is they give us a lot of insight into what the market thinks is going to happen with this stock, namely around how much this thing is going to move in the future. The reason this is the case is that options act as a form of insurance used by big firms to protect themselves from major moves in a stock price. So what we can see here is for SAVE, we currently have an implied volatility of 134%. So what does this mean? What this means is based on the current demand and supply for options in the market is thinking that SAVE is going to either move up or down 134% in the next year. So what we can comfortably say here is that the market is implying that Spirit is either going to shoot up to the moon or go bankrupt within the next year. So when we're trading the options around this thing, we need to be careful because that means the options are going to be very expensive. But for a stock trader, this is also very valuable information because it tells us that what the market thinks is that it's only going to one of two places in the next year. It's either going back up a lot or it's going to go to zero. So if you have some form of directional bias, let's say you're extremely bearish on this stock, it is still not a bad time to be shorting it because if you are correct in your assumption that it's going to continue to move down, the market thinks it's going to continue to move down a lot. And if you are bullish on this company, it is not a bad time to buy in either. Because if you are correct in your assumption that it's going to move up, not only is it going to move in an upwards direction, but it's going to move up a lot. So that's my view in terms of the stock analysis of this. But if we look at it from an options perspective, we find a different kind of opportunity. And that's where I bring in the PA forecast for realized volatility. When we're trading options, we're not so much concerned always with what direction the stock goes. We're more concerned with how much the stock is going to move. And what we're seeing here is that the market thinks that this stock is going to move a lot when we account for things such as the supply and demand for the options. But when we look at our realized forecast, which takes into account a bunch of mathematical models to try and really create an accurate prediction of what's going to happen in the future, we see that we're actually expecting this to move a lot less than what the market thinks, regardless of if it goes up or down. So, knowing that, we can structure a trade where we're short not the stock, but the volatility of the stock. And the way we can take advantage of this is by structuring something along the lines of an iron condor, which lets us take a short view on volatility in the market. When we look at a few more details, we see that the relative action, which is how much action is actually going on around the stock. Is there a ton of people trading options around SAVE right now? We see that there is. It is actually at its highest quantile that it ever gets to. So relative to how much action this thing usually gets, we're at a 10 out of 10 right now, with 5 being the average. We also see a lot of skew to the put side, which tells us that in general, people in this market for this stock are more bearish than bullish. And this makes a lot of sense. And it's something you see with a lot of the other airlines as well, because the big funds that own a stake in these companies need to protect their positions. So they use the options market as a way to hedge themselves by either buying puts or selling calls. Now, one more thing that tells me that the market might be overreacting to how much volatility there's going to be right now is that SAVE recently had their earnings, and the implied move for the earnings was 18%. The market thought that on this earnings event, there was going to be an absolutely massive move. But when it actually ended up happening, there was no move. The move was almost zero. It was very, very small. And if you can see, if you were buying volatility around this earnings, you actually would have lost 20% of your money. A huge, huge loss to sustain. So this further confirms my view that the market is overstating how much this thing is going to move in the future, right? The market thinks that it's going to the moon or to the dirt, but we think it's still going to move a lot, but because we think it's going to move less than what the market does, we have found a market inefficiency that we can structure a trade to exploit. So if you have any questions about how you would structure a trade around this, or if you have any questions about my analysis, shoot me a message or leave a comment below. I'll be happy to break it down with you, right? This is a really good trading opportunity, whether you're a stock trader or an options trader. And by taking the time to look at the information we have at our disposal and making a really educated opinion on where the trade really lies, we have a lot of money that can be made here. So thanks a lot, guys. Make sure to subscribe, and I'll talk to you in the next video.